Hello financial fans, welcome back to another stock analysis. Today we'll be looking at Crocs stock ticker CROX. Crocs is a renowned footwear company that specializes in designing, producing and selling a wide range of shoes. They are most recognized for their iconic clog style footwear, which is made from unique and proprietary foam resin material. Crocs' shoes are known for their exceptional comfort, durability and versatility, making them suitable for various activities and environments. The company has expanded its products offerings beyond clogs to include sandals, sneakers, boots, and more, catering to diverse consumer preferences. Currently, the market cap of Crocs is sitting at $6.6 billion. Their revenue in 2022 was $3.6 billion. 75% of their revenue from Crocs come from the Crocs brand, and 25% from the Hey Dude brand, which is other types of shoes that they also sell. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 20%. That can never be below 0%. Margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using our scale. When we're using 4 colors on scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from our margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. First two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT over the years has gone up, going from $22 million in 2017 to almost $900 million in 2022. The average EBIT growth over these years is almost 123%, which is a 10% deduction in the margin of safety. This is paired with a margin that has gone from 2.15% all the way to 25.26%, growing by almost 79% on average during this period, which is another 5% deduction in the margin of safety. Final two metrics that we'll be looking at are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. And for Crocs, this is just over 2.5 years. In this case, a 256% debt to EBITDA ratio, which is no change in the margin of safety. The return on invested capital for Crocs is sitting at a very nice 18.6%, which is another 5% deduction in the margin of safety. Looking very good so far for Crocs. Let's go look at the valuation models next to determine the intrinsic value of the company. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of Crocs going from 2016 to 2022. The average growth in their free cash flow annually during the period is almost 124%. I'm projecting an expected growth rate in the next 10 years in a free cash flow of 10% annually. With this, we can determine the future free cash flow for Crocs and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $14.5 billion. To get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $12.1 billion. And dividing this by the amount of shares outstanding gives us a discounted cash flow price per share of $195.50, which is an 85% upside from the current price. The second model that we'll be using is Graham's revised valuation formula. This model will be taking a look at the earnings per share that Crocs is generating. We'll be using the growth rate estimate projected by Wall Street. And we'll be looking at the average yield of AAA corporate bonds, which is always sitting at 4.4 in relation to the current yield of corporate bonds. And we go by the theory of Benjamin Graham that the PE of a company with no growth is always sitting at 7. Looking at all of these metrics, we get a fair value of $153.76, which is a 45.5% upside out of this model. The third model that we'll be using is the multiple valuation. In this model, we'll take a look at similar companies to Crocs, look at their stock price and earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is 25.1. All we have to do to get a fair value then is to multiply by the earnings per share that Crocs is generating, which is $9.25 a share, giving us a fair value out of this model of $232.28, which is a staggering 120% upside, almost. And the last model that we'll be using is the mean reversion theory. This model, we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this is the PE ratio. In this case, I've imported the PE ratio of the past 5 years, and on average, it has been sitting at 23.25, while the current PE ratio is sitting at only 11.41, indicating that it's currently severely undervalued on this metric. It gives us a 103 8% upside out of this model. If you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon. Anyways, getting that self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at the final overview, we've imported the discounted cash flow, range valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $199.22. Margin of safety we've determined earlier using a standard margin of safety of 20%, looking by 10% for the EBIT growth, 5% for the margin growth, and 5% for return on invested capital, leaving us with no margin of safety at all. This gives us a fair value of exactly the same as the average out of all of the models, and with the current price of $105.66, we get an upside of 88.55%, indicating that it's currently a buy out of our models. If you want to see any other companies on this channel, please let me know in the comments. And thanks for watching.